Chief Investment Officer. I'm the Chief Investment Officer here at Cutler, and I'm joined today by Bryan Knuston, a certified financial planner and senior wealth management advisor. And Bryan is based in our Seattle office. I am in our Bellevue office today. I had to close my shades because it's so sunny here in Bellevue today, but let's get started and jump right into it. So thank you, everybody. And as always, these are our disclosures, and new information becomes available all the time, and we are changing our views as that information does become available. So please always consult with your financial advisors. Reach out to us here at Cutler if you have questions about anything that we're saying today and how it might impact you or your portfolio. Let's talk about it before taking such action. So what are we going to do today? We're going to start with a third quarter review, what happened over the summer. We're now a month into Q4, so we're going to spend the rest of the presentation really looking forward. Where is the recession? We're going to ask these three important questions. Where is the recession? War, politics, and debt. What should investors do now? We're getting questions about those three topics on a daily basis, and really we want to address that up front. Talk about what you're concerned with, what is keeping our clients up at night. And then finally, what about cash? Everybody has questions about cash. Should they be adding to their cash? Should they be investing in their cash? Should they be selling stocks and buying cash? As you might guess, the short answer to that last question is we still believe stocks are the right place for an investor's portfolio. We also believe bonds have a place in an investor's portfolio. And cash, we believe, is a great defensive position. It's paying very nicely right now, but not something a long-term investor should be looking at. But before I give too much away, Bryan, why don't you talk about the third quarter? Tell us what happened and how we think clients should be positioned today.
Sure. Okay. Hi, everybody. So what happened in the third quarter was quite a bit of a transition from what we saw in Q1 and Q2, where there was a very focused leadership group in those first two quarters, the stocks, the Magnificent Seven, the big stocks that we've talked about before, and we'll touch on those again today. Those stocks took a little bit of a breather in the third quarter, and they let some other leadership slide into their place, which is good. We cannot continue to have leadership that narrow. So what happened, big picture, let's start at the top there. Bonds, and in this case, like aggregate bonds, the entire class together was collectively down for the quarter. The biggest reason for that was long bonds, and that's bonds, say, that mature in 10 years, 20 years, 30 years, started to get swapped out in some portfolios for shorter bonds. We were already short bonds, we were already in shortish bond positions, which is why our view there says increased duration risk. We believe that looking backwards, we did not go into longer bonds because they were too expensive. What helps that? Prices coming down. The prices came down. We are now looking at that as an opportunity instead of a risk. And we're looking at the idea that we have been short, and we're going to talk more about that. Let's look at stretching out. On the stock side, that second bullet there, the mega cap tech rally, it didn't get a big drop, but it took a pause. And what took its place? Energy stocks, oil stocks, for multiple reasons, including some global tensions, which we're certainly going to talk about, other things, led that class to be the clear winner in this third quarter. That's also just what happened in 2022. We had one clear winner last calendar year that happened to be the same class this third quarter. There's some different reasons why, but energy did stand out. And what do we look for there? We're going to talk more about ideas going forward, but basically we think there are a lot of stocks that are good valuations because there are so few stocks getting all the concentration and all the attention that are not good values. Foreign stocks, they had some modest drops as well, pretty similar to the U.S. stocks. There's some different reasons since we're talking about a wide range of markets there. One of the big ones was some growth concerns in China. They're still trying to figure out what they're going to do for going forward. We still like that class, of course. They trade cheaper than us. They have higher dividend yields than us. This has been true for a while. It's still true going forward. The fourth class is interesting. So alternatives, we use one particular fund there, one or two, in most client portfolios. That fund has done very well. It has outperformed bonds. It has been much less volatile than stocks. However, it's almost at the point now where we look at it and go, thank you for your service. we might be looking somewhere else. Maybe not with the entire weight, but with some of it. The biggest reason why we have used that class mostly as a proxy for bonds, somewhat for stocks, but mostly for bonds. Now that bonds have much stronger yields and better prices, which we'll also talk about, they look, there are other things that look as good or better than that class right now.
Yeah, thank you, Bryan. And just, sometimes we can talk in inside baseball and use terms that may not be familiar. One of those is increased duration risk versus credit risk. There's two risks generally associated with bonds. One is that they will default. That's credit risk. And you can think of junk bonds as low quality companies that might be on the verge of bankruptcy. They have a very high credit risk. The other is how long are those bonds that you're investing into? What is the maturity date? That's the other risk. That's duration risk that we're referring to there. All right, so let's move on to the first of the big three questions. Where is the recession? It sure is taking a while. We've been looking at some trends out there in the economy, and this chart shows the leading economic index, which is an index of indicators that measure the probability of a recession. And you can see at the very right there, it kind of traded sideways a little bit, not further down, which is great. It's not continuing to decline. But if you had a chance to read our market commentary, we sent that out this morning with today's invitation for this webinar. But if you look through that email or go to cutler.com and go in the commentary section, you'll find our commentary. We included a quote, the quote from one of the people that work at the conference board, which makes this leading economic indicator. And I want to read that quote to you. With August's decline, the U.S. leading economic index has now fallen for nearly a year and a half straight, indicating the economy is heading into a challenging growth period and possible recession in the next year. That's not a great quote, right? It definitely, as an investor, you think, uh-oh, we're heading into a recession. And one of the themes that we really want to emphasize for you today is that doesn't mean sell your stocks. Stocks can bottom well before a recession. There are certain parts of the market that are doing well. There's certain parts of the market that are doing poorly. It is our job to look to identify opportunities in each of those, and we'll continue to do that on behalf of our clients. But we do not advocate selling your stocks and trying to time the market, because getting that timing exactly right is nearly impossible, and investors have typically been at a disservice when trying to do so. But back to the economy, back to the recession. Here we have another indicator called the inverted yield curve. And I talked about maturity or duration for bonds. Normally, and you can see on the top, a normal yield curve, as you move out in maturity, you get paid for that risk. For the last 18 months, we've had an inverted yield curve, which means as you go out in maturity, you're getting paid less. Right now, cash or a money market fund is paying you 5.25%. You're getting less than that for a 30-year treasury, which no wonder there's a lot of interest in cash and money markets. Bryan, what does this inverted yield curve mean? Can you walk us through the bottom of the bottom chart here?
Sure, yeah. So I think Erich explained the big picture of it well. I should, in theory, get paid more for holding a bond that matures in 10 years than I do for 5, and for 20 years than I do for 10, because of the risk that other bonds could come along in the meanwhile and be better than that one I'm holding, whether that means it has less chance of default, and defaults are usually very rare, but still less chance of one, or it could have a better coupon for going forward. Towards the end, we're going to talk about some bonds and what's going on with that marketplace on pricing. But here, what we're looking at is right now, and for the last year to year and a half, excuse me, depending on which comparison we're making, which duration level, we are seeing that there's an inverted yield curve. That top right there shows you you're getting paid more right now for holding a 3-month treasury, one that matures in, I guess that would be January, than you do for a 6-month, a 1-year, a 5-year, a 10-year. That is inverted, right? You're getting paid more on the short end than the long end. That happens because there's an expectation that rates will go down. Well, that near term, the near term rates, how do I explain it? Will be lower in the future and that I'm not going to want to stretch out. I'm going to stay defensive until such time as those longer bonds look more attractive. What can make those longer bonds more attractive? Either the short end, the Fed funds rate, essentially what the Fed controls coming down, and or the longer end having prices sell. Because if you think of it like a teeter-totter, if bond prices go down, your effective yield goes up, and vice versa, right? So what I would want there for that long end to go up is for bond prices to go down, which they are. Down on the bottom right there, what do we see? Those periods in pink are periods of inverted yield curves. What have those led to? Recessions in each one of those categories, each one of those time periods, I should say. They're not the same. They're not the same length, and they're not the same level of recession impact. Some of them are very brief and very mild, which is what I still think is going to happen this time. I'd say probably but some of them can be quite a bit longer. But each one of those has a period where, in this case, it's the 10-year, which is the one that's the most commonly viewed, versus the 3-month. You can look at any comparison, right? 10-year versus 2-year, whatever they might be. If a longer bond is providing less current yield than a shorter bond, that is one of those recessionary signals that was talked about on the LEIs, the leading economic indicators, on the previous slide.
Right. So another leading indicator could be credit contraction. What are banks doing out there? We did have a mini banking crisis earlier this year. You can see here that bank credit is contracting. That's something that historically does not take place. Another negative indicator here. We're not going to beat the drum too hard on this recessionary point. This is the last chart we're really going to show that I think indicates negative economic news. Housing affordability. We've seen with 8% mortgages, housing affordability at all-time lows. That is something that really is a conundrum out there. How do housing prices stay up while affordability is down? Something has to give, right? I think a lot of buyers are anticipating refinancing at lower rates at some point in the future. Hopefully they will be able to do that, but there's no guarantee with this Fed that rates will come down aggressively or even moderately in the near term. All right, so that's the negative news. This slide is definitely a very big yet. Bryan, what is on this slide?
What we have here is the composition of gross domestic product. GDP is going to be that measure of economic activity. There's a lot of different factors that go into it. The biggest factor, you can see on the right-hand side, you've heard us say this in the past, and it's still true, consumers, right? Our willingness and ability to purchase the things that we need and the things that we want, some combination of both, is that light blue box there that's 68%, 2/3 to 70%, somewhere in that box there, is going to be us. That's going to be our actions that we take for things like utility bills that we don't want to pay but we have to, and a trip that we really do want to pay for and we do. That has been the biggest question mark about economic activity, would be our ability and willingness to continue to spend. Some of it, again, because prices are going up. We're going to touch on that some more later. And some of that for some discretionary buys. Those discretionary buys piled on top of the things that are just on a more recurring basis are the biggest driver of this economic activity, which has continued to be positive. Some of the areas are a little more slippery on the slope than some other ones, but on the consumer side, it has continued to be very stable.
So you look at this chart, you see 2.2 in the first quarter, 2.1 in the second quarter. In the third quarter, GDP blew away expectations, 4.9%. The number was released last week. And we spent the first 5 slides talking about this drumbeat of a recession, and yet 4.9%, call it the Taylor Swift bump, whatever it might be, 4.9% contributed very strong growth. And as we look forward, here's the current chart from the Atlanta Fed. This is as of last Thursday or last Friday. You can see their first estimate for fourth quarter GDP is coming in above 2% as well. Now, the blue chip consensus, which are economists out there who are generally a little more sour than the Atlanta Fed, is saying we're going to have growth somewhere between negative and 1.5, call it. So the Atlanta Fed is still well above consensus here. That doesn't sound like a recession. So we're really getting a mixed bag of data. We're getting positive economic growth At the same time, we have these leading economic indicators which suggest a recession is a possibility or even a likelihood. There's really no way to reconcile those two points, but here we are. What's interesting about this current Atlanta Fed estimate is that they're estimating 2.3% currently. Of that, 2.04% is coming from consumer spending. Bryan already mentioned it's a big part of our economy. It's a really big part of our current growth trajectory. Bryan, are consumers getting squeezed from all sides, yet they keep spending? Can they continue to do that? What are your thoughts?
I just don't know how we can continue at the pace and scale that we have. I said that 6 months ago, and we have continued to find a way. But what this is showing is that the capacity to spend is starting to come down a bit. And here are some reasons why. There's 3 different charts here showing 3 different things, all sort of coming together to one point. So let's look at each of them. Top left corner there, this is a survey by the Fed of New York asking borrowers, households, so this is not with businesses, this is households, how they feel about their ability to obtain credit if they need it. We can see here that there's 5 different sections, but the ones that really matter are the red and the pink. Those are the 2 areas of respondents that say it is much harder and somewhat harder. The much harder is usually going to be your very low credit score people, right? If you can't get a $2,000 secured credit card or whatever the circumstance might be, you're in a tough spot. You can see that line really hasn't changed dramatically going all the way back to 2015. This scale, by the way, goes from 2015 to last month. So when you look at that, the red part isn't that concerning. The pace of change, yes, that is something to watch out for, but it's that pink box. The pink box are probably people, if you know your credit scores, those are probably like the 650 to 700 people. There's a lot of those out there, and they should be able to get some credit. They'd like to get some amount. They could probably get less than that. That is an area of concern, because if they don't feel like they can get money available to make the buys that they want to or need to make, that could be something that could be a headwind for us going forward. Bottom left, this is an aggregate of household excess savings. Back in 2020 and 21, activity was restricted. A lot of payments came in from some government sources and rebates and such. And the personal savings spiked, right? We're looking at $6 trillion on that first blue spike before the shaded blue area. Wow, right? That came back down. Then we had another spike. That came back down. Coming back down makes sense, right? We have a lot of kind of relief spending, a lot of pent-up demand. The problem is on this one, the crossing under the dotted line and going negative. This is when we're out of cash. If you think about this, though, I saw a good chart. It's not here, but think of it in 5 sectors of people, right? You have the top 1% and then all the way down to the lower end of income. The top two, sort of say top 20%, still have excess cash. No surprise, they had more cash to begin with. It's the rest of us. The problem there isn't necessarily the discretionary spending side, because a lot of households aren't really going out to make fancy buys. It's what are they going to sacrifice to make the other choices that they need to make. That's going to be the question mark there. And then on the right-hand side, if you want to know how do we go from positive savings to negative savings, well, you use credit, right? Okay, we know how this works. There's a lot of different kinds of credit. You can borrow off your house. We all, not all, sorry, but many of us have a large amount of equity. You can use some cash savings, or you can use credit cards. Credit card, the amount of credit card balances right now, really, if you smooth this over multiple decades, it's not that outrageous. The number is $1 trillion, which sounds shocking until we show you a chart about where the balance sheets of consumers lie. $1 trillion is manageable on its own. What really happened there was we were on a trajectory. That trajectory dropped thanks to lower interest rates and a lower spending. Now that we're back, that number doesn't concern me. What concerns me is the credit of the interest rate being applied to those credit cards. The number there in blue, you can see where that dotted line is, 21%. That's hard, because what you're used to is 10, 12%. If that effective rate doubles, that's money that you have to spend that you're not getting anything for, just because that's what the applicable rate is. That's the area of concern, is not so much what has happened, but what the impact will be going forward of the trade-offs that have to be made.
Yeah, Brian, in a couple slides, we're going to show government debt, and the government is suffering from a similar trend here, where the payments, because the interest rates are higher, have really ballooned. This is the last kind of backward-looking or economic chart we have here in this presentation. It's the consumer balance sheet. It's still in good shape. The consumer is still okay. You look on the top right here, debt payments as a percent of disposable personal income. Other than the pandemic period, 2020 through earlier this year, we're right at historical lows. So 9.9% has been fairly stable. A big part of that is mortgages have been locked in. Most consumers in America locked in those mortgages for a long time period. And so that debt is not fluctuating quite so much. And we're also seeing household incomes growing along with wage growth. So overall, the consumer is okay. There are some cracks in the dam. There's a little bit of opportunity for consumers to slow down. That might impact GDP growth as we move forward, but it has not yet impacted GDP growth. All right, so then let's ask the next big question: war, politics, and debt. What should investors do? There are a lot of things that are on investors' mind right now, and we just put some of the big ones here on this chart. But obviously, a potential government shutdown in November. We saw a breakout of war in the Middle East recently. We had the U.S. House without a speaker for nearly a month. We have the Ukraine war still going on. And we added another one on this chart, which is not at the forefront of people's minds, but could be, which is a conflict between China and Taiwan. Does China take advantage of, these are all things that are at the forefront of investors' mind. None the least of the U.S. debt. We recently, in the last couple of years, went over 100% debt to GDP. That had a lot to do with stimulus. It now has a lot also to do with interest rates. Over 50% of U.S. debt is short-term. And as rates have gone from 0 to 5.25% on the federal funds rate, that short-term debt gets refinanced at higher levels. We now have $1 trillion of interest expense on U.S. debt annually. That's really just an incredible number, and it's something that investors need to be aware of. So what should investors do? Well, let's talk about the last decade, really the last 13 years, and look at the reasons to sell stocks. There have been reasons to sell stocks, throughout history. And if you had sold them right at the precipice of one of these inflection points, you would have done very well. For example, if you sold stocks right at the onset of the first COVID-19 related death in the United States, you would have saved dramatic upside or downside. 6 months later, however, if you were still in cash, you would not have done as well. And the problem that we have as advisors is clients getting that timing perfectly correct. Obviously, they say stocks go up in an escalator, but down in an elevator. You never know when that elevator is going to arrive. But for our clients, we recommend staying the course, staying in the markets, because as you look forward 5 years or 10 years or whatever your investment time horizon might be, those dramatic drops look like they do on this chart. They start to become blips on the radar. They're not as dramatic in retrospect. And we think investors need to keep that long-term real return in mind. It's important to remember that stocks have a historical real return, not inflation-adjusted return, or inflation-adjusted return of 6.5%. In a higher inflationary environment like we find ourselves today, stocks are a great place to store your cash as a hedge against inflation. I was at a conference last week and heard Jeremy Siegel, a finance professor from the Wharton School, my alma mater, and he said stocks aren't a good hedge against inflation. In his words, they are a perfect hedge against inflation. So keep in mind the long-term benefits of owning stocks if you're considering looking at other asset classes. So one question investors want to know, are U.S. stocks expensive? And as we look for opportunities out there, this is an important question to ask. And the answer is yes and no. Bryan, why might it be both?
Here we go. Let's let me try to play both sides of the fence on this one. Okay, so here are a couple of reasons why stocks are expensive. The first one would be if you look at that box in the middle there, and you can see those different inflection points going back to 2000. The biggest difference between today, or let's say the end of September, I'll call that today, 17.8. The average stock in the S&P 500 on this chart is trading at, well, round up a little bit and say almost 18 times earnings, right? You take their annualized earnings, multiply by 18, that's the price that we have right now. Historically, the average has been closer to somewhere between 15 and 16. But let's compare where we are on this chart to the last couple of instances next to them. The difference that jumps out to me right away is in 2020 and 2022, I was owning stocks in some cases, depending on my kind of risk profile, almost maybe more than I wanted to, because look at those treasury yields, 1.6 and 1.6. What is it today? On this chart, it's 4.6, and as of this morning, it's closer to 4.9. That's a trade-off, right? It doesn't mean I don't own stocks. It means maybe I own a little bit less than I would otherwise because I can get that effective yield. Okay, the other part of this to keep in mind is that 17.8 is a very well calculated number based on future projections. That's not what they are today. That is the expectation for the next 12 months. It's down there in the fine print, but I'll tell you, it's the next 12 months based on sort of a wide set of estimates, not just JP Morgan. They're the provider of this slide, but this is, it's not just them. It's a whole bunch of providers who think that is where we are. If you took the most recent actual earnings and you took today's price, it's closer to a 20, give or take. It's, let's just say 20. It's very close to that. That would be a bit rich, right? So it depends on a couple of things. Treasury yields as that trade-off. How much does that matter? Someone, I say almost all of us should have stocks and bonds to some degree, but also on that ability to reach the growth aspect to make that PE ratio come to life. If it can, like 17.8 doesn't concern me. 20 has me a little concerned, but if the growth metrics can make us reach that number, that would alleviate some of that concern.
So this chart shows the S&P 500. Let's break that down a little more because I think there's a third leg of the stool here, which is mega cap valuations. And if you look at the top 10 stocks in the S&P 500, they're trading currently at nearly 26 times earnings. The average historically has been 20. So they're 128% above average. Well, what about the remaining 490 stocks in the S&P 500? 16.8. Not a rich number by any means, pretty close to the long-term average. That really, I think, sums up the opportunities that exist out there as you look around the marketplace. Should we continue to overweight the top 10 stocks, or should we look to diversify portfolios? Bryan, look at on the right side of this chart. Anything jump out to you?
Yeah, so my concern on this part, and this is what I would say going back to the previous chart, and I get from clients all the time, are stocks, at fair value or overvalued or undervalued? And to try to give a wide basket answer is hard because most of them, the majority of them, are trading at good to very good valuations right now because a lot of them have been overlooked in favor of this top 10 list. So what's going on? The comparison between these two, if you look at the top right, how much is the weight of those stocks in the index? Well, where does that come from? That depends on the market price, right? That has nothing to do with earnings specifically. That has nothing to do with what the company is. It's how much are traders / investors willing to pay for those stocks. That number is probably kind of hard for people to see on the screen, but the top 10 stocks comprise 32%. So let's say 1/3 of the weight of the S&P 500. So out of 500, I think it's like 503 today, 500 stocks, 10 of them make up 1/3 of that index by the size. Okay, well, if they're that big, are they contributing that much to the bottom line? No. The bottom right says that they were, if you can see that spike and then the drop, they were contributing 1/3 of the earnings results of the S&P 500. Now that is closer to 22%. Okay, so if these same 10 names are 32% of the weight, but only 22% of the earnings, then they're not holding their water to enough degree. That's my concern with that list. Not every member of that list, but that, that macro list there of 10 names, that gives opportunity though for the other names, not all of them. There are some stocks that I wouldn't own in that remaining 490 plus, but there are a whole bunch of them I look at and go, those look great, right? And why? Because they are out contributing their weight just based on these ratios, right? Everything adds up to 100, and there's a displacement there. There's a difference there that we can take advantage of.
Yeah, and it's probably not a surprise, but if you look at that 490 stocks, I think there's an outsized number of dividend-paying companies, value types of companies, and given Cutler's historical biases, we like that dividend space. Historically, 49% of your return as an investor in stocks comes from dividends. We think looking forward in a higher valuation, kind of lower growth environment like we find ourselves today, income is going to be increasingly part of investors' total return. So identify those opportunities where you might get paid to wait, where you might get paid consistently, like bond coupons or dividend stocks. We think that's a great opportunity for investors at this point in time. Let's talk about another one of those here on the next slide. This slide is called Buyers Have Opportunities to Find Upside. And this just shows global valuations. We've shown that before. You can see actually the US, focusing on the right side of this chart, the US trading is 17.8 times forward earnings. We've already shown you that statistic. The 2021 number was 21 times. But as Bryan mentioned, we have a higher rate environment, so some contraction in that multiple makes sense. But what really jumps out on this slide to me is Europe. 12 times from a 2021 number of 15 times. There's some attractive valuations out there. And actually, if you look year to date at an equal weighted European index versus an equal weighted US index, the equal weighted is outperforming even with a strong dollar. So international diversification is working right now, which hasn't been the case for quite some time. Let's talk about diversification, Bryan. This is year to date through September 30th. Anything to be said that hasn't been said already looking at this quilt chart?
Sure. I think what jumps out to me on this one is that if you look at this chart, the black box is big US stocks. That's both value and growth style, right? And the black box tends to be in the middle. If you drift back in history, going back to 2008, excuse me, the black box tends to be in that middle chunk, right? I usually think that there's, I think, 10 classes here, and they usually end up somewhere between 4 and 7. Okay, the last few years, that's drifted up a bit. Why in particular? I know there's a lot of sort of tannish looking ones, but the one that's at the top this year is large growth. Once again, right, as it has been in multiple years recently. The only note I would make on this before we get into specifics about bonds is on the stock side. What I've noticed is sort of some thought that big tech stocks are a bit of a proxy for safety, right? They have this wide moat, which means they don't have a lot of competition, and they're doing really well, and they have all the sales growth. Okay, and I've actually heard a couple of clients say, well, yeah, well, those look like they're protected against drops. Well, hold on a second. The last time I can tell you that that box of stocks had a big drop was last year, right? Not saying they're going to again. I just mean no class is impervious to that sort of volatility, regardless of who that is, right? Like, look, last year, the worst performing class was large growth. Just saying, right? Any class is subject to this. Let's not look at a stock of any kind and say that's a proxy for safety. No, a stock has volatility by their nature. What this shows me is that that has the capacity to go both ways. That's why diversification, even at those times where it doesn't feel like it's working, history will show it is. It just isn't always working in the small set of time that I'm looking at.
Right, that's a great argument for diversification, for identifying opportunities of valuation throughout the US markets as well as the international markets. One thing I want to point out on this slide, short-term bonds, call that a money market fund. That's the kind of the equivalent of money market funds. As you look back over the last 15 years, they were the lowest return asset class for 5 of those 15 years. If you take the bottom 3 boxes here on this chart, they were the bottom or in the bottom 3 for 9 of the last 15 years. So cash can be a great defensive position, but ultimately stocks and bonds both have outperformed cash. That's why we own those investments, right? We want to own stocks because over these time periods, stocks have given us better returns. So cash is great. If you have cash sitting in the bank or on the sidelines, it's great to put to work. In fact, I'm jumping the gun a little bit because the next question is, what about cash? Let's talk a little bit more about cash versus bonds and why an investor might want bonds at this point in time. About a month ago, the Fed came out and announced that they were on hold. The Fed never really says things that clearly, but the market interpreted the Fed to being on hold. Higher for longer is what they're calling it. So if the Fed is on hold and we're at the end of the cycle, this chart really shows what cash versus bonds has done at the end of the cycle historically. So take the last 4 Fed pauses, 95, 2000, 2006, and 2018. Where's cash a year later versus where are bonds a year later? U.S. Treasury bills are the proxy for cash here. And you can see they've been somewhere between 2.4 most recently to up to as high as 6.3 a year later. But look at bonds in that next next column. U.S. investment grade corporates a year later had returned 20%, 14%, 7%, 14%. And why is that? Well, the Fed often pauses at times where there's a less robust economy or where inflation is coming down. Both of those are supportive for bond prices. So if the Fed were pausing because of those reasons today, we would anticipate a rally in bonds. That's why you want to have that bond exposure. U.S. money market rates are at 5.25%, but as the Fed cuts, those adjust nearly overnight. So you don't have any locked in rates in today's higher rate environment should you be in a money market fund. If you have short-term cash needs, if you're buying a house, if you have money in your bank account, absolutely put those in a money market fund. You can lock in some higher returning rates, however, by pushing that into bonds, buying some U.S. Treasuries or investment grade corporates in this case. All right, so Bryan, what is happening in the bond market? This is the bond section of our presentation. Obviously, what jumps out are those big negative returns on the left side of the page here.
They do indeed. Yeah, I'm sorry to make you endure a couple more talks about bonds here, but this is important. So what we get on the left-hand side, excuse me, is going back to 1928. This is the total return. So that's the change in market price, because keep in mind, bonds do trade on an open market. They're not just issued at $1 or $100. And the coupon received, right? The amount of interest payment that you receive. If you look back historically, the idea of having negative years is not that rare, right? It's not common, but it happens in some batches of time. And often what's interesting here is you'll get 2 years in a row in several of those instances, especially back in the 1950s. And then you'll have some where you'll have a negative and then a very modest positive the next year. Why do we have potentially 3 years in a row here, right? 2021 had a decent size of negative. 2022, the worst year for bonds of all time. 2023 started off fairly positive, sort of pulling in the reins. Some of the reasons we talked about before, that inverted yield curve, I'll pull in tight and get my 5% instead of sticking modestly sticking my neck out. Because look at the years 2019 and 2020. And we said it at the time, if you go back and watch our old webinars, who doesn't want to do that? If you look at those 2 years, you will see us saying, why are bonds up this much? Why are bonds up this much? You had coupons of 2, of 3, and you were getting total returns of 10, 11%. That's outrageous, right? It's easy to say it in retrospect, but I promise we said it then too. And the reason why that was happening back then, excuse me, I'm sorry about that, is that we had coupons of 3 at the very long end and 1.5 at the short end. And some traders out there said, I will pay up, remember, because they're on an open market, I'll bid up and overpay for those longer bonds. Why would you possibly do that? Because they assumed, probably because the Fed said so, that they weren't going to increase interest rates. Whoops, we've talked enough in the past about the mistakes the Fed has made. That's one of them, and that led to some overpricing. If you look at those 5 years in combination, what that's really done is get back to about neutral. So we look at this as, I'm sorry about this, as an example of why we've sort of hit the reset button on bonds. They got overpriced. We stayed short. We didn't see upside on taking that risk. Prices have come down, come down, come down. That's one of the reasons why we're talking about looking to modestly extend duration. The right-hand side paints the picture for this pretty well as well. This is excluding the interest payments, just the change in market price, right? So open market, you have a bond, it gets issued at 100. I have seen, no exaggeration, treasuries that were trading at 140, 145 per $100 of value. That's insane, right? And we said it at the time, that's crazy. That's why we sold some of them for clients. What we see here, look at those drops in market price, right? 10, 6, 5. If I had something that issues at 100 and it got up to 110 and I could get 105 for it or whatever the price might be and get out, great. But what are we also looking at? This is a chance for us to get in, right? The very same reasons that left-hand side said we were appropriate when we said, whoa, let's temper our enthusiasm here and stay short, are the same reasons why it could make sense now to modestly go long. We're not talking about buying a whole bunch of 30-year treasuries, but just pushing out a little bit more and a little bit more. We could take advantage of prices coming back to reality, all the better.
All right, and our final slide today, and I find this to be very interesting because really for the last year and a half or so, inflation has been front and center in our webinars. And here we have our last slide, and it's our first inflation slide. And I think that's good news. It is indicative that inflation is coming down. Our view is that the fight is not over. You can see on the far right, actual home prices up 40%, but CPI shelter up only 17.9%. There's a differential still in some of the data and some of the CPI numbers. As we continue to work through that discrepancy, inflation might linger higher than what we want. However, the Fed is winning the battle. Inflation has come down significantly from the 9% rate we saw earlier this year. And that has justified the Fed being on hold. It's also supportive of both stocks and bonds at these levels. So with that, I just want to say thank you. Again, our takeaways are that we want you to be comfortable thinking about stocks as a long-term investment. Let's not worry too much about a recession, but let's use that as an opportunity to rebalance, to look for valuation opportunities out there. Let's focus on diversification and make sure your portfolio is best suited for you. But if you do have any questions, please do not hesitate to reach out to your advisor at Cutler, to either Bryan or myself, and we'd be happy to talk with you at any time about your portfolio and how it might be best positioned for you going forward. So with that, thank you so much, and have a happy Halloween, everybody, and we'll talk soon.